All right, we are seeing pressure across the board. Tech is a pain point, but as you can see, the TSX getting caught up in the selling pressure. This is we're seeing weakness in tech as well, but also in materials. Healthcare is actually the only sector to the upside. So kind of a broad sort of risk-off kind of day. We did get a read of inflation that didn't really play along with this narrative that inflation is a one-way street down to 2%, particularly in the U.S. Let's bring in Christine Tan, portfolio manager at SLGI Asset Management. Thanks so much for joining me.
Good morning, Amber. Thank you for having me.
On one hand, these tech stocks are doing what they're supposed to. They're beating expectations. They're growing a lot faster than the market.
Exactly.
But investors want more. And they're so concentrated. It's such a huge part of the market that when they don't do well, the entire market suffers.
Gets pulled down. I think you characterized it perfectly. It's one of those things where it's like if your child usually gets good grades, right? They come back with an A. You're like, where was that A plus?
That's
joking.
Asian parenting.
Yeah, exactly.
You and I know about
That's
that.
Right. That's right. I think to your point, the actual quarter numbers were good because they beat. But part of it is we have to be aware there's a bit of a guidance game. So generally the level of beats in the U.S. market is pretty high. But to your point, it's more about the guidance. So if you listen to what Microsoft has said, they said we're data center constrained, which means Azure, their cloud services business, is going to grow less in next quarter than this quarter. So that's what the market's really focused on. And then for Meta, the AI story is a little bit more difficult to see directly because it's about engagement, which you talked about in the previous segment. But how do you really measure that? If you spend more time on it, what's the monetization schedule? So what's clear to us, though, is in this earnings season so far, there's a big gap between AI beneficiaries and those that are not AI related. And then there's a big focus on CapEx, rightly so, because if you're going to be spending billions, I think I heard a stat that, Microsoft is spending more in a quarter than an entire year pre-COVID, right? So in CapEx. So you want to see the ROI come through.
And yet, I mean, there definitely are green shoots. The U.S. economy is doing incredibly well. The consumer is holding up amazing in the U.S., stark contrast to those that are exposed in China. So you do have, I guess you got to weave that situation in, right? Because there definitely are spots that are thriving.
And I really like how you characterize that. So what we've been saying is there's a difference between the economy and the market and the earnings outlook. So the economy actually has been quite resilient, and I use quotation marks now when it comes to Canada, for the last 2 years. But earnings have actually been in a recession for many sectors, other than the big tech names and maybe a handful of companies in Canada. So now you're seeing the opposite, especially in Canada. The economic data is softening for sure, but earnings has been bottoming out and on the margin getting slightly better. So you do need to kind of look at the specifics, but also be aware of what you're paying for those companies, right? Because valuations can be quite challenging. And tech is exactly that perfect example, what's priced in valuation-wise versus what they actually deliver.
I wonder, too, if it's not just prudent to take some money off the table because we've run up so much, up 40% from the lows in October for the S&P. The TSX has, we caught up.
We've caught up.
We've caught up.
That's right.
You've got jobs, you've got an election, you've got a rate decision. This is all in a week that we have to contend with this.
And we probably won't even know who the definitive president is next week, just given the high number of mail-in ballots. So there's a lot. And again, at the start of the year, we certainly will not calling for this type of equity market returns. So to your point, I think thinking about how to rebalance, how to rejig and kind of re-risk your portfolio, but maybe taking a more conservative approach is important at this point.
You mentioned the economy doing well in air quotes, because obviously that doesn't really include Canada at this point. And we just got a fresh read of that confirmation of a sluggish growth in Canada at a time where I think the conversation around how that's showing up in the Canadian dollar, the rate differential between Canada and the U.S. What's the consequence of that? Like, you as an investor, how do you think about where is this going to dent your portfolio? How can you make money off of this?
So, we, as an asset allocator, we think about that a lot. And to your point, it's a very different story. If you look at the GDP by industry number that came out this morning, now to be clear, it's lagged, so it was the August number. But essentially came in flat, which was what StatCan had sort of guided towards the last time when they released July data. But if you look at internals, there are things that kind of are worrisome, and that's probably why the Bank of Canada is still leaning towards doing more versus the Fed. Manufacturing has been very weak, especially durable manufacturing. Non-durable is always noisy because you get pharma in there, you get some retail goods in there and things like that. But the only segments that are consistently growing are financials, to some extent, the financial service segment, and then public administration, which is the size of the government, right? So you look at that and you think, well, where are the jobs? And where could there be sensitivity? And where is there cyclicality? And you are seeing that weakness show through. So going on to your point on the Canadian dollar, that divergence matters because clearly in the last few weeks, we've seen the entire curve in the U.S. back up because now you're pricing off some Fed cuts and maybe more concerns about longer-term inflation implications if we had one candidate win over the other. But in Canada, it's the opposite. The data continues to soften, and certainly Macklem has made it clear. Q3 average inflation is now square on 2%. So they're basically saying, without actually announcing it, inflation battle is done. We're now focused on the growth side of the picture.
And you're touting that they did 50, they could potentially do 50 again.
Correct.
I guess my question is, are they constrained in their ability to do this because maybe they're not so worried by Canadian dollar at 70? Does it start to get problematic sub 70?
Absolutely. So Macklem's always been very careful because he gets asked a lot about the rate differential. And he's always said, well, we've diverged in the past and we're not at that point of what we consider a limit yet. But to your point, it is important because if you look at components of CPI like food, for example, that is impacted by a weaker Canadian dollar because we import a lot, and some pharmaceutical goods as well. So he has to kind of think about that. However, on the other side, though, if you think of the biggest components of CPI like housing, those are more domestic, and those clearly would benefit from a lower rate environment. So it depends on how he battles it out, but on the margin, I think right now the focus is still on the weaker growth and wanting to make sure that they do something to sort of alleviate that.